Good morning. Tuesday, August 18th. More war headlines. Oil going in the wrong direction. Crude 84 and change. Brent over 90. Bonds don't love it. We continue to ignore what is generally weaker economic data. 815 print of ADP, 9,500. So not continuing to go in the wrong direction, or as it were, maybe right direction for rates. Still a sub 10,000 number, up from 8.25 last week. So continues to really not give us any reason for pause from an economic standpoint. Overnight, not a lot of data. Asian stocks generally worse, but mixed. European stocks generally worse, but somewhat mixed. Here onshore, indicating worse across the board. NASDAQ leading the charge, down over a point. VIX up over 15, up about 3%, 15.68. That's been pretty subdued recently. Bitcoin better. You're almost starting to get that feel, and make no mistake, I'm not a Bitcoin expert, and maybe I should be, right? Doing what we do, because I'm always, as somebody that's looking for market direction before it happens, maybe I should be. But what I'll say is this anecdotally. I feel like in the recent past, Bitcoin has been kind of moving in the opposite direction of maybe stocks and or commodities, whereas up until the last month or two or three, it just seemed to be in the same direction. And theoretically, that's what Bitcoin should be, right? I mean, there's I know that it's there are a lot of elements to it, but one of them is that Bitcoin survives X crisis, and kind of name as many as you want, because it's I don't know, bulletproof or whatever, the ultimate commodity, if you will. There's this theory that there's a finite amount of it. I guess we used to think that about gold and diamonds and oil, and I don't know, you wonder by definition, and let me read the official Reader's Digest definition of commodity. It's interesting. To me, a commodity would have been something that theoretically has somewhat finite resources, but the literal definition is not that. I guess where I'm going with it, and I still think that there is this element of a finite amount. You go back to Trading Places, and the reason why they were bidding up the price of of frozen concentrated orange juice is because there was going to be less of it because it was a colder winter. Prices fluctuate based on global supply and demand. The key characteristics: units meet a uniform base grade line used as raw materials to create finished goods and services, and supply and demand help fluctuate the price. To whatever extent that supply and demand is I'll use a delicate word, dubious, right? I don't know. We price oil as though there's a finite resource, and I don't remember the last time we talked about how, holy cow, we ran out of oil. Speaking of running out of things, though, I do think it was interesting yesterday. I don't know if you guys saw these headlines, and they're not new, but these headlines resurface from time to time as though these are new things. I guess there's some sort of call for potential food shortage next year because of I don't know, the lack of fertilizer, crazy stuff. Anyway, the whole point of it is, I do find it interesting that Bitcoin has been doing better on the bad days, which to me makes it a bit more of a hedge on stocks, which to me is what it was supposed to be. And the question is, if you weren't bidding it as a hedge on stocks and now you are, what does that say about a certain segment's viewpoint of the market and to a lesser extent the economy, or how the economy affects the market? I think there's some lessons to be learned there that are beyond this morning's conversation. Commodities, gold, copper, silver, platinum, all down. Gas, oil, crude and Brent variety, all up. So no real shock there. 8:30 data, building permits up, import prices way down. So much for your inflation mumbo jumbo. I'll say this for about the millionth time. Not all higher prices are inflation, but all inflation are higher prices. So last month, we posted a number of 0.3. It was revised down to negative 0.3. I don't know what to say about that, right? I mean, it's just preposterous. It's ridiculous that you could post a 0.3 number and be off by 0.6, so much so that it's actually a negative. Import prices went down last month at an annualized rate of 3.6% to be exact. We said that they were going up by 3.6% at an annualized rate. So inflation, if that's what we want to call it, and it's not exactly that, but import prices were actually 7% different than what we posted. And if the Fed were determining monetary policy on the basis of import prices, and they're not, we'd have like this massive intra-period rate cut, I guess, right? Because do you want 3.6% deflation? Anyway, we expected 0.1 and we came in at negative 0.4. So to put that into context, we expected a 2-month average of 1.5, or call it annualized 2%, 2-month average of import prices. And we printed something more along the lines of negative 4%. So much for inflation, if that's what we want to call it. Housing starts missed, and we're down big. Permits up, starts down. Okay. And bonds don't care. Both of those numbers are bond friendly. To whatever extent you think housing data is bond friendly, and I suppose to the extent that it's a measure of the health of the consumer, I suppose to the extent that we have a president who seemingly is concerned about the affordability of housing, but it doesn't seem to matter in the context of ending this skirmish in Iran. I don't know what to say about it. Long story short is this data this morning, and just to be clear on that, we've got a sub 10,000 print on ADP, up week over week, but still not a great number. Big miss in import prices and a big negative revision, and a big miss in housing starts, drop month over month. On the heels, excuse me, of yesterday, us printing an okay NAHB housing market. So the housing data has been a little bit mixed. I don't know. The Fed minutes tomorrow theoretically won't have any of this in there, right? I think what we're hoping for in the Fed minutes, at least among the dissenters, and the non-dissenters, because who knows? I mean, I might have voted to hold rates, but I wasn't convinced, but I wasn't dissenting, right? Is we theoretically won't get any commentary about the softness of this data, right? But will we get commentary on the question of how they perceive the conflict affecting the price of oil, natural gas, and crude and Brent oil, and how that would potentially translate to the pump and how that would potentially translate into the price of things in a potentially softening economic climate. And I think we talked about this in the May numbers. I forget, a couple months ago, but what does the Fed do? And again, we don't have a Fed meeting. We have Jackson Hole this month, but the September meeting, let me just pretend here for a second and say that the August round of data that hits in September is brutal. 2 straight months of negative jobs. CPI, again, sort of explicably or inexplicably doesn't reflect, the bouncing around of oil prices. Retail sales, although I don't know that we'll have retail sales before Fed. I think we will. Weak. But, and here's the but, conflict, morning, Angela, but the conflict is not over and we're still worried about oil prices and therefore inflation. What the heck does the Fed do? Right? Because, I would imagine we'd suppose that this conflict can't go on forever, right? The Fed has already determined that whatever impact the price of oil and gas has on inflation is transitory. So how do you put us into restrictive or further restrictive territory when the economy is screaming that I might argue that you need accommodation, right? I mean, I don't know if we were to, and this is a big if, but if we were to print 2 or 3 straight months of job losses, headline BLS job losses, I mean, it wasn't too long ago that we were talking about rate cuts. How is that not on the table? So I don't know, very complex and not for the faint of heart. I think it's easy. I think that monetary policy should first of all not be a thing. I believe in a free market, but to whatever extent we need monetary policy, I think that it should be consumer facing and not statistic and data facing. I don't care what inflation is. If we have a booming consumer, I think you should raise rates, and I don't care what inflation isn't. If we have in that case, if we have a dying consumer, I think that you should cut rates. I think this idea that every decision that everybody makes to spend money is fully and wholly driven by interest rates, I think is somewhat of a preposterous contemplation. However, and as with all of this stuff, none of it is just that easy. Is this economy and the global economy is as highly leveraged as any economy has ever been. So to totally argue my argument, hey, dummy, if everybody is leveraged to the gills, of course the only thing that matters is interest rates, right? I don't know, maybe. I keep saying, to the extent that Alan Greenspan was one of the better or more notable Fed chairs, and I always go back to the irrational exuberance. To whatever extent that you're trying to manage the economy through monetary policy, right? You raise rates to deflate, if you will, that irrational exuberance. I'm going to spend whatever I want, whenever I want, no matter how much it costs. If you raise rates on this economy right now, what exactly are you accomplishing? Are you driving down the price of oil and gas? No, you're not. And so therefore, you are making it more difficult for people to afford things they already can't afford and based on the data aren't buying. What the government should do and how they should manage the economy is through a fiscal policy, fiscal austerity. The more they borrow, the more they spend, the more they devalue things. And that is sort of the definition of inflation. The money you have, right, is worth less relative to what you would use it for. What do I know? Anyway, tomorrow we roll ginnies. NBA apps, not that that moves rates. Fed minutes at 2, so that's really all we care about for the most part tomorrow. Philly Fed claims, S&P Friday. If I look at a chart right now, I don't have as much conviction as I maybe did yesterday about 6s and 6.5s, but for the most part, they're full on lock-ish. 5s are getting closer to that float territory. That's 5.25, 5.75 note rate. 5.5s, which are 5.75 to 6.125, 6.25, or maybe 50-50-ish. Good lock day yesterday, so you're listening. At this point, right, if you're still floating August, you haven't been listening. I don't know what to tell you. To me, you're looking for the end of a conflict. And the rhetoric from the White House was, I'm in no rush. So if you're kind of going to take this risk into tomorrow, hoping that you're going to break this trend, you might be right. You might. But this is about probability. And probability tells me that you'll probably be wrong because while we flip-flopped a great deal, I don't know how you go from I'm not in a rush and, oh, by the way, we're going to bomb the shit. And I think that's a direct quote. Don't hold me to that. We're going to bomb the shit out of Oman if they get in the way, who's an ally for those who are keeping score, theoretically. I don't know how we're going to go from that to tonight. Everything's great. We've got a truce. Oil is $60 a barrel. So to me, today's a lock day. The September stuff at this point, if I don't know that one thing has anything to do with the other based on this import price to whatever extent. It's probably a C-level data point. I'm even more emboldened to want to float longer term for this September setup, if you will. All right. I will see you guys in the morning. Thanks for joining and watching on replay. Have a great day. Bulls and Bears make money. Pigs get slaughtered.